Windfalls, that unexpected money that just kind of falls from the sky into your hot little hands. So what should you do with it? Better yet, how can you intelligently evaluate what your best option is for the use of that money? Well, in this episode, we'll look at somebody who is going to receive about $200,000 from a generous relative and the options that they have available to them on what to do with all that money. We'll even go over a very specific method that should make the best option stick out to a person like the Milky Way and the shooting stars flashing across the night sky as we sit by the mountains on a warm summer's night at our lake house. Wait, was that too specific? Too dramatic? Well, what can I say? I have a vivid imagination. Let's go look at this scenario, shall we? Welcome to Minding My Money Mondays, a common sense talk about money matters. I'm your host and tour guide along this journey, Jared Rogers, CPA. If you're new to the channel and never want to miss another money-saving tip, then I suggest you subscribe. To do that, simply click on that little cartoon dude in the lower right corner of your screen. And don't forget to click on the little bell icon. That way, you'll get notifications every time a new video is posted. Okay, so a question came to me this week about what to do with some money a person was going to receive. After going through a little back and forth via DM, I actually thought that this was a little too involved to answer that way, so why not turn it into an episode? And thus, here we are. So the question was, what should this person do with some money that they were going to come into? Now, at first I was thinking this was like a small amount of money, but when I asked how much, turns out it's like $200,000 that a relative is going to give to them. Yeah, let's just say that's a little bit different than hitting $1,000 on a scratch off. You see, windfalls can take many forms. They can be that $100 bill you find blown up against the fence in your backyard. And that's a true story. That actually happened to me when I was a little kid. And I was like, I'm rich! Now, what can I do with all this money? What can I go spend it on? In the end, I think I bought one of those high-power Radio Raheem boom boxes. I mean, come on. I was a little kid, and I wanted to be just like all the big kids, a.k.a. the high schoolers. And if you don't know what a boom box is, go and ask Siri or Alexa, you young whippersnapper. Windfalls can also take the form of a tax refund, an unexpected raise or bonus at your job, lottery winnings, inheritance or a gift from a wealthy relative, or proceeds from an insurance claim, disability, or a legal settlement. Unfortunately, they can also be the result of you being the beneficiary of a retirement account or a life insurance policy of a loved one who recently passed. In many of these situations, the money is usually unexpected and large enough that one might be confused about what to do with it. Which brings us to the options. When a person gets a windfall, there are 4 specific things they can do with it. They can spend it, save it, invest it, or share it. Spending it is typically the first and most obvious option to people. What can I let this money burn a hole in my pocket on? But besides buying things, there is another way that one can spend their newfound money, to pay down debt. I talked about spending savings to pay down debt in this video, so I won't talk about it here. But I do recommend you watch that video when you get finished with this one. Saving your windfall is another option. You could park it in a savings account, a bank CD, or some other asset to just keep it safe for a rainy day. And there's nothing wrong with that. Sometimes it takes a person a while to figure out what they truly want to do with their windfall. And parking the money someplace that pays them some money on top of that money, while they decide, that's not a bad option. For those who want to make a lot more money on top of the money that they receive, they'll usually consider investing it. This could include dumping it into the stock market, buying investment properties or real estate, or using it to start a business. All of these are options, and it's just up to the person to decide which one is the best for them given their goals, time available to manage their investments, and station in life. If you're 75 years old when you get a windfall, what you select as an investment option could look completely different than someone who is 25 years old given these things. Lastly, a person could decide to share their windfall. They can split it with relatives, a friend, or a spouse. They could use it to fund their volunteer efforts. They could donate it to their favorite charity. Or they could simply walk down the street giving random strangers $20 bills. But if you're going to do that, then please make sure you wear a mask. I don't want you getting COVID-19 while you're trying to do some good. So how does a person select the best option for them? Well, they could go with what they feel is the best use of the money. But seeing as I'm a finance person, feeling never got me good marks with my bosses when I was in corporate. In those instances, we would look at something called opportunity cost. Opportunity costs represent the potential benefits an individual, investor, or a business misses out on when they choose one alternative over the other. The idea of opportunity cost is a major concept in economics and one that is often used in corporate finance. Put simply, the concept of opportunity cost centers on three key ideas. The first, the opportunity cost is the benefit that a person would have received, but they didn't because they chose a different option. Second, to properly evaluate opportunity costs, the costs and benefits of all the available options must be considered and weighed against the others. Third, considering the value of opportunity costs can guide individuals and organizations to make more profitable decisions. But it does not, in and of itself, tell you which option you should select. While all this might seem unclear at the moment, let's take a look at our friend's situation as an example. After that, I'm pretty sure it'll be crystal clear.
So our friend is going to get $200,000 as a gift from a wealthy relative. And all of the options look at the benefits over 1 year. So the options are for them to spend, save, invest, or share. Under the financial results section, we're going to see what the benefit is that they will receive by doing each one of these things. And under the financial benefit section, we'll see the financial benefit that they'll get. So the first thing they can do is they can spend it on things, and the result is going to be happiness. The financial benefit is going to be priceless. However, in an opportunity cost analysis, the benefit is actually zero. Then when it comes to spending on debt, they could spend it on debt. And in this particular example, we're going to say that they take the $200,000 and they use it to pay off a mortgage. And for simplicity's sake, we'll say it's 5%. Yes, 5% is high right now. But $200,000, 5% for a year would mean they would save $10,000 in interest. The next option they have is that they could save it in a bank account, and a current bank account is probably going to pay 0.65% interest, and at $200,000, that would be $1,300. They could put it into a CD, which would earn a little bit more interest than the bank account, maybe 1%. So that would give them about $2,000 of a benefit. They could choose to invest it in stock, and the S&P 500 thus far for 2020 has given a return of about 10.33%. So on $200,000, that would be $20,660 in a return. They could decide that they wanted to invest it in a vacation home. And let's just say that they take the vacation home and they rent it out at, let's say, $2,000 a month. So they can get $24,000 a year, which would be a 12% return on investment on the $200,000. The picture you see on the screen is of me and my wife, and every year me and some college buddies take a trip to the Smoky Mountains and we rent a cabin. The cabin that we rent is owned by someone who rents out the cabin. So just like this person rents out their cabin, our friend could go ahead, take the $200,000, buy a cabin and rent it out, make some money off of it. The person could also go ahead and invest in a business. And let's just say it's a delivery business. You know, COVID-19 right now, nobody wants to go to the store, nobody wants to pick up things. So they offer to do those things for people. After their revenue and their expenses, they profit $25,000, and that's a 12.5% return on their investment. They could simply share their money with their friends and their family. Once again, this would be a result of happiness and it's priceless. Or they could decide to share, meaning by giving it to charity. So with regards to charity, they're allowed to get a tax write-off for the money that they donate to a charitable organization. Here we can see the federal income tax brackets that are going to be in play for 2020 and 2021. Let's assume that the individuals are married filing jointly and that their taxable income falls between $171,000 and $326,000. We can see that that will put them in the 24% marginal tax bracket. So when we look at their scenario, them being in the 24% tax bracket means that if they gave $200,000 to a charity, they would receive a $48,000 tax write-off on their tax return. So after the opportunity cost analysis is done, the last thing to do is actually do the evaluation. The $0 with gray is the option versus itself. The yellow section is where you give up when you pick a certain item. And then the green section is usually where you benefit by picking a certain thing. In the end, when we look at all the options, the best options for this person are to either give it to charity or to invest it. However, there is a hidden opportunity cost that also should be evaluated. If they save it in the bank or in a CD, or they invest it in any of those other options, not only do they make money from their investment, but they still retain the $200,000 principal. But let's say that this person actually doesn't want to give it to charity. Let's just say that they say they only want to look at their investment options. We know right here that the person is going to get either $20,000, $24,000, or $25,000 by picking any of their investments. But when it comes to which one is better, they get $3,300 more if they invest in the vacation home as opposed to investing in stocks. And if they pick the business, they would get $4,300 more as opposed to just simply investing in the stocks. So in the end, it's really just going to come down to what's best for them. And that's the whole point of an opportunity cost analysis. It will not tell you the best option to pick. It will just simply help you narrow down the best option for you, given your particular circumstances.
So in the end, there are two ways that you can figure out what to do with your windfall. You can go off of what you feel you should do with it, or you can evaluate the opportunity cost. While there is no right or wrong answer about what you pick, hopefully you can see how doing a thoughtful and fact-based analysis can lead you to the decision that is best for you. And just like that, looks like we've come to the end of another episode. If you have a question that you would like us to answer in a future episode, you can send it to questions@makemymoneymakesense.com. That's questions@makemymoneymakesense.com. And if you found value in this video, please give it a thumbs up. That way, YouTube will recommend it to others who might be wondering what to do with their cash windfall. So like I always say at the end of every episode, it's been fun, it's been real. I'm Jared Rogers, CPA. And until we meet again, let's all continue to mind my money, and I will see you all next Monday. Take care.